Welcome to the webinar on stock valuation and relative valuation. This is Vinit Bolinchkar here, and uh, I would like to uh, sorry for the glitch there. Welcome to the valuation of stocks and relative valuation. And today we are. This is the most juicy topic, but before that, I would like to thank one and all for attending this webinar. The entire student community and investors from all over the world. My sincere thanks for having me on this show. And a little bit more about myself. I am Vinit Bolinchkar. I'm the head of research with a premier broking firm. I have over 20 years of work ex in the stock markets. I love to teach. I love multi-baggers. Want everyone to be rich. And valuation is the entire game which is going to help you become rich, identify multi-baggers, and grow your wealth. But before we take off on this course, I would like to introduce to you the master course on picking multi-bagger stocks, which is going to start in the month of February. This is the first of its kind program which I have designed, keeping in mind the passion for multi-bagger stocks that people have. So this is going to include module 1, which is a 70 hours of exhaustive training on fundamental analysis and valuations. This will be followed by a 1 month real-time analysis of a stock idea that is a potential multi-bagger. In this, we will jot down a list of stocks which have the potential within their industry, and then we will shortlist them based on the criteria of elimination. Then we will undertake real-time study of the shortlisted stock with financial analysis and forecasting, valuation which we will learn today, and estimate the value market potential. This will also be followed up with a management meet and or conference call with the management for the stock under study, and we will correlate this with its peer group for analysis of key characteristics and convince ourselves that the idea that we have chosen is absolutely the best in the industry. So writing multi-bagger stocks is not an easy game because there is a tendency for people to buy a stock only when it is going up. When the stock is going down, people start panicking, and when their investment goes into profit, there is a tendency to go and book some profit for the fear of missing out. So this 1 week boot camp will help us to buy multi-bagger stocks cheap. It will change your psychology around holding them and riding them through the rise cycle. It will train you to be patient, helping you track them through the holding period with respects to the milestones achieved while reassessing potential. Then we will also look at selling and booking profits because ultimately only if you sell you will make the money. And timing the exit for non-performing stocks will also be looked at in this. And this will all be done with the help of psychological analysis and training for developing a multi-bagger mindset. Mind you, this is the most important part of staying with a stock over the long run, buying it cheap, and selling it in the euphoria. And as we go out into the future, technology is taking on a very important realm, and we will be using a 6D principle for identifying future exponential stocks. This will help us understand emerging disruptive business opportunities, networking to identify businesses in these spaces, and then we will be evaluating the emerging high growth businesses for viability, growth, market dominance, and sustainability. We will also look at early stage investing in these business opportunities. And trust me, the world is entirely at the stage of a disruptive technological innovation, and the next 10 years are not going to be what they are today. They're going to be extremely dynamic and moving forward. And it is This disruption, which is going to throw up opportunities, and if you can identify the right stock, believe you me, what kind of returns you got in 20 years, you will get in 10 years. So, this 6D principles of investing and their application will be very unique. Now, I have received a lot of inquiries for this stock, and people want to know what is the cost. Well, uh, it's only 18,000 rupees for this entire information that is available to you, and you be the judge of its value. Moving on with our webinar today, we will be covering these various aspects of valuation, which is DCA valuation, which is the most scientific method for valuing stocks. We'll be looking at PE, PEG, EV by EBITDA, uh, EV per ton, price to book values, sum of part valuations, and then touching upon dividend yield, EV sales, free cash flow yield, and other such measures. So, right, let's get on with the first one, that is DCF valuations. So, before that, we need to understand what valuation is all about. Valuation is essentially the process of determining the current or future worth of an asset or company. And depending upon whether the current price is lower than the future price of an asset or company, the purchase of that asset is considered attractive. So the entire process of valuation that we undertake is to estimate the future value of a stock vis-a-vis its current value. And if the value of the future is much, much higher than the current value, it becomes a buy. And if the value of the future is lower than the current market price, then these stocks are definitely avoidable. This is the most scientific method of valuation, and is DCF is the most scientific method of valuation, and is particularly used when is a steady certainty of stream of future cash flows, their timing, and expected rate of return, which is also known as the discount rate, is known. This is what a investor is looking at to earn from the choice of various asset classes. Now, the free cash flows are essentially of two types. Free cash flow to firm. In this, all cash flows prior to interest obligations are considered, and free cash flow to equity, in which all cash flow payments, post interest obligations, and preference shareholder payments are considered. So let us look at how this calculation of FCFF and FCFE is done. So first we get the earnings before interest and taxation, or EBIT. And from that we deduct the tax, which is a chargeable outgo. We add back the depreciation and other non-cash charges. And if you see slightly lower, our non-cash charges include amortization of capital expenses. So these are expenses which are booked before starting the business. They sit in the P&L and they are not incurred actually, but they're written off in the P&L. So we write them back. And any loss on sale of asset which are added back. And gain on sale of assets are deducted from both the methods. Then increases in working capital are deducted, and so are any increases in capex. So from this we get the FCFF, and this, or the free cash flow to firm, and this is discounted by the weighted average cost of capital. This weighted average cost of capital calculation we'll see a little bit ahead. So this is essentially how the free cash flow to firm is calculated. Now let's look at how the calculation of FCFE is done, of free cash flow to equity. So the starting point for this is the free cash flow to firm, and from this interest is deducted and net borrowings are added. So that is how you get the free FCFE, and FCFE is discounted using the cost of equity. So the difference between the two, as we saw, is that the FCFS is discounted by the weighted average cost of capital, which includes debt and equity, while as in the calculation of FCFE, only the cost of equity is concerned. So I believe this would be a little heavy for you people just now, but when we go to the next example, it will become much more lucid in its understanding. Before that, we need to look at a few terms. So cost of debt, which is, or KD, is the suffix for that, is generally the prevailing interest rate for a comparable credit quality. And cost of equity is essentially the risk-free rate plus beta. Beta is nothing but the change in the stock price vis-a-vis benchmark like the index, okay, into the difference between the return expected on a stock market portfolio and the risk-free rate. So this is how the cost of equity is calculated. And the weighted average cost of capital is essentially cost of equity into equity divided by equity plus debt plus cost of debt into 1 minus tax. We have to take into consideration taxation into debt divided by equity plus debt. And the summation of that will give you the weighted average cost of capital. Since a business is theoretical in perpetuity and cash flows cannot be at the end, the terminal value is calculated. So what happens is that a business is typically you can project for 4 to 5 years or maybe for 10 years at the outside when you expect the growth to be dynamic. And once when the the high growth period of the stock is over, it generally tends to return to a very pedestrian level of growth, which is generally around the growth of the GDP, or it grows but at the rate of the inflation. So we get the terminal value from that, and DCF is nothing but the summation of the cash flows for every year divided by the discounting rate. And the pitfalls and the discount rate in this case is the weighted average cost of capital. I know this might have been a little bit confusing, but when we go to the example on the next page, it will be much more lucid in understanding. And what are the pitfalls of using the DCF method? One is that it is very difficult to precisely ascertain what are the exact measures of the input values, and this model can be prone to error. So if you assume higher growth rates and actually that growth doesn't come about, then the net present value or the discounted cash flow can be impacted severely. So this is the example of a company which is called ZLearn. Okay, to give you a brief background of this company, ZLearn is into the business of play schools and K-12 education. Now these two businesses have got very high predictability because generally the number of students, the fees, and all that are typically known for a very long period of time. And hence we have used a discounted cash flow method because there is very high probability of ascertaining cash flows over the length of the business. So here what we have done, we had initiated this work in 2016 and we have projected for a period of 10 years. So now based on our cash flows, this is how we arrived at uh, uh, at the at the net present value. So essentially what we have done is we have calculated the EBIT from the forecasted P&L statement, and we have accounted for taxation in that. So we got EBIT into 1 minus tax rate as these values in the first row. From to that we added back depreciation. Now this continuous decrease in capital, working capital, hence we have subtracted that. Capex kept on increasing, hence we have deducted that, and we came up with the free cash flow to firm. Also, we have considered into play the net debt. And to this, we've added the discounting, which is required based on the previous formula, which we had arrived at earlier. And you can see that the terminal value at the PV was 1908. This is the value of the terminal growth. The total enterprise value was 2546. The value of debt was about 35 crores net debt. And from this, we got the equity value, which was 2510. And dividing per share, we got the value of 77. And when you compare with today's CMP of 47, and that is when the uh, report was generated, The upside was clear 63%. Now notice if you go on the higher side, you can see the calculation of the weighted average cost of capital, where the risk-free rate, that was the prevailing rate of the GSECs, and assuming a risk premium of 4%, the beta was calculated at 0.85. We got a cost of equity of 10.8, and after tax cost of debt was 4%. So from these all were used, and we got the weighted average cost of equity as 10.35, and the terminal growth rate was assumed as 6%. Well, I know this would have been a little difficult for all of you people, but once you become part of this course, this will become a piece of cake as we take it up. Looked at the DCF model, let us look at the various other models which we are all very conversant about. And the most popular one of them is the price to earning multiple. This is essentially used when the growth is in a high growth phase. And the PE, or the price to earning valuation, is typically found out by dividing the current market price by the earning per share. Now, whenever the high PE is there, it typically indicates that the stocks are valued expensive, or that the market expects sustained high growth in the future, because of which the valuation is high. So let me just break this up a bit. So when we say high PE, so what can happen is that a business, the market has run up and it is indicating a high value, or it could also be the case where the business has got extremely high growth prospects going forward, and hence the market is discounting that in the current presence, and that is why the high PE is there. Alternatively, the converse would be that there is a low PE, so a business might look undervalued because it's there is not much certainty about its future earnings, and hence the PE is low. Or there would be one which is discounted to low because of low prospects going ahead. And typically the PE multiple that you can use can be based on historic earnings, which we call a trailing multiple, or one based on forward earnings. Generally, we use the forward earning multiple only. And so let's look at a case of this stock. This stock is Solar Industries. If you notice, over the period 2007 from a EPS of 2.2, when the PAT was 19.2 crores, the EPS of the stock has grown to 20, or it has gone up 10 times in a period of 10 years for a typical compounded growth of 25.5% in a 10-year period. At 25% over this period of 10 years, it is not an uncommon performance. It is an extremely uncommon performance. And notice how the PE of the stock has gradually risen. So it was 10 in 2007, 1 year forward, and it has today moved to 37 times. And so one would argue that you're using historical, you're looking at past performance. But the outlook of the stock, as you can see in the future table, if you can notice that from 1580 crores of revenue, we expect the FY19 revenue to touch 2600 crores. So the growth momentum is expected to continue, and hence we believe that the high multiple will sustain. In fact, what we have not included here is a 2020 multiple, where we expect the PE to drop to 20 based on the FY20 earnings. And hence, assuming a 35 multiple, the stock has substantial room for growth. Now let's look at what we say are relative valuations. So when you look at an industry, we also need to look at the different players that are there in the same industry set. So these are the four stocks: Solar Industries, Keltec, Premier Explosives, and GOCL. If you notice, the revenues of solar industries are in thousands, while as the other three companies are practically no one is more than 500 crores. Okay, so this the sheer size of the company, its dominant position in the industry, has ensured that the stock has sustained at extremely high P's all along. Okay, now compared to the P, if you see these numbers, you will notice what I'm trying to bring out to you. Yes, Premier Explosive has also had comparative earnings in the past, but on a forward basis, solar industries continues to be more expensive. So this is what I wanted to highlight to you about P multiples and relative valuation. Now, when a stock is very high P, it is very difficult to give buy calls on them. So we introduce what is called the growth adjusted price to earnings valuation model, which is called PEG for short. This model, as I explained to you, is typically used when the P multiples are high of extremely high growth stocks. Now, what we have done here is that we have used the dairy industry uh, to display how the PEG can be used. So if you notice on the y-axis, we are calculating the 2-year forward ROE, and on the x-axis, we have a 2-year forward PEG ratio. So typically, if the PEG ratio is small, that means that the stock is extremely attractively valued. And based on this model, we had earlier chosen two stocks that were Quality and Prabhat. But between Quality and Prabhat, Quality had got issues of governance, and hence that stock was omitted, which left us with Prabhat. Prabhat clearly had a potential to grow at 30-35% CAGR over the next 3 years. And that when we initiated this report, the price of the stock was about 120 rupees. And today the stock, after touching a high of 235, is trailing around 215 odd levels. And this is the essential journey of that stock from being zero point 0.2 on the PEG scale to 0.55 on the same scale. So any number which is below 1 is considered to be worthy of investment, and anything above 1 is considered to be generally avoidable. So this is how we can use the PEG ratio to identify good stocks. And I've just shown you how we've used a filter of quality or governance management to decide between two stocks which had the same. If you notice, Quality had a superior ROE of 35%, 28%, while Prabhat's ROE was only below 15%. So just by elimination, we have now looked at Prabhat. So if Quality were to get it act together and satisfy the street that uh, it would not be indulging in any questionable behavior or antics, I'm sure the stock would get sharply re-rated. Only time will tell how it performs. But the dynamics of the Quality stock continue to remain attractive. The next valuation model that we use is the EV by EBITDA, or what we call as an enterprise value to EBITDA ratio. So how is the enterprise value calculated? Basically, we take the market capitalization, which is the number of shares into the share price. To this, we add the market value of debt, and all the cash and cash equivalents are deducted. So that is how we get the enterprise value. And when you divide the enterprise value by the EBITDA, you get a ratio which is used in accordance with how the PE multiple is used. Now, the company in whose numbers you're looking at are that of JSPL, which is a steel company, which is cyclical business. And if you notice, it has got very high interest payments. If you notice, interest payments are almost as high as the EBITDA. and the debt to equity is also quite significant. It's 1.4 as of FY16. And if you notice that the PAT in FY16 and FY17 was negative, so the P multiple could not be used, because how would you value a negative profit business? So we had to use an alternative method of evaluation, and hence, considering that the stock has got high debt, we have used EV by EBITDA multiple. So if you notice on historical basis, the EV by EBITDA of this stock in the bottom right hand corner was 16.7 for FY16, 11.5 for FY17, and as the business starts getting profitable with the steel cycle improving, its EBITDA based on FY20 is coming out to be 4.0. Now this number by itself does not mean anything, but when we look at this sheet and we look at the EV by EBITDA of its peers, a lot of things become visible. So for example, Tata Steel has a EV by EBITDA of 7.2 in 18. If you take Steel Authority, it was nearly 13. JSW Steel was nearly 7. And Prakash Industries, a virtually debt-free company, had a EV by EBITDA of 6. So what this means, however, this Prakash Industry is much smaller than the other four players and essentially not comparable. So what it essentially means is that if Jindal Steel does well, then this ratio of 4.0 in the year FY20 is much lower than the average industry multiple, which is in the range of 6.5 to 8. So even if we assign a multiple of 7 to it, it would mean that the stock price should jump significantly. And although the EV by EBITDA, if we assign an EV by EBITDA of 7, it would mean only a 75% upswing for the enterprise value. But because of the reduction of the debt, the market cap of the company would go up sharply. And on the basis of this kind of analysis, we had predicted that the price of JSPL would rise from 150 rupees when this report was published to 450 plus. Now only time will tell what will happen. Today the stock is quoting at 200, and so there has been an upside of around 30% on the stock, and we have put a value of 450 plus. So I believe as time plays out and the steel cycle edges out its growth, the valuation will come through. So this is how we do the relative valuation of we saw the other example of relative valuation of price to equity. Now another variation of uh, EV by EBITDA could be considered to be EV per ton ratio. So typically, this is what I use when valuing businesses, which are cyclical in nature or generally are commoditized. So here there is a classic example. This valuation was done when Dalmia Bharat, the stock under consideration, was around 350 rupees. And the company had got major aggressive plans. They had become the fourth largest player in the country. They were targeting the fast growing areas of Northeast and Northeast. And during that time, there was a sizable variation in the EV per ton calculation of uh, the top three majors, which are Ultratech, ACC, Ambuja, and Dalmia Bharat. So if you notice that not only on the capacity basis, but also on the basis of cement sold, there was a drastic variation. So on an FY16, that was the time when the business was under play. On a historical basis, also it was quoting at uh, close to, but like ACC, if we consider ACC, which was the cheaper of the three, nearly half that. So there was a sizable valuation gap based on EV per ton. And the performance of the stock has clearly vindicated our stand. Today, the stock stands at 3,200. and it has almost in a 10 bagger from those levels. Now, if you're wondering why we have two values for Dalmia Bharat, that is because there was another company, OCL, which they were on the verge of acquiring. So combining the OCL earnings, its EV per ton was 85 on capacity basis. Now, the price to book value ratio is generally used to value stocks where the earnings are negative, and it enables comparison across companies in an industry where accounting standards are quite consistent. Mostly these are used to value financial stocks. Again, the principles employed are the same as in EV by EBITDA and PE. Okay, but here I want to introduce another element to our analysis. So if you consider this chart, this is typically the price to book value of the stock, and the ratios down which are there, these indicate from green to blue, typically indicate where the price is in relation to where the EBIT 1 year forward price to book was 3, 3.5, 4, 4.5, and 5. The center line, which is the purple line, which is 4x, is the average 1 year forward price to book that the stock has traded on over the period of the last 7 years. Okay, so if you notice that it has gone to 4.5 on the higher side, and generally this kind of methodology which I have developed in-house is very good for identifying stocks which are considering their historical valuations. So this green line and the blue line are stress case and euphoria based valuations. So what do you mean by stress case? So the green line typically indicates what the stock would have been valued at in times of extreme duress, like maybe a meltdown of the 2009, and over the period 2010 it has never crossed the brown line. So that typically that brown line would have been a very nice level for buying stocks, and typically whenever the stock has hit the orange line, it had generally uh, been one where you would get cautious and look to book profits. Having seen this, I am now going to go a little step further to show you that despite the extreme valuations, why we continue to remain bullish on the stock. Mind you, when this report was done, the price of the stock was around 1300 rupees. So for analyzing banking stocks, we need to really get into the macro factors. And if you notice here is that this period from 1996 to 2004, the average GDP growth was 5.8. From 2004 to 2009, that was just a period before the crash, was around 7.8. Then from 2009 to 2012 was 7.5. And then we had a mini recession in the country. From 2012 to 2014, the GDP grew at shade under 7%. And during that time, it was expected that the GDP would grow at 7.6% uh, over the period of the next 5 years from 15 to 22. Now, if you notice that in the first period, the the system credit growth or the total loans available in the banking system grew 3 times the GDP, which is 5.8. This number came down to enhanced to 3.42% because the system credit growth grew at 27%, which was 3.42 times this. In the period between 2008 and 2015, this credit growth period kind of multiple came down from 2.3 to 2. And we had assumed that the system credit growth of the banks at a lower rate of 1.8 times the GDP growth would happen. During that time, if you notice, the HDFC Bank grew at 93% from 96 to 2003, which was 5x the system growth. Then it continued to grow at between 2004 and 2008 at 40%. Then it came to 33, then 24. And we have said that the growth will continue to happen 19.5% over the period FY16 to FY22. So this is what the growth we were expecting in uh, credit for HDFC Bank. This was what we had done in terms of uh, forecasting, and this would be typically back of the envelope calculations. Now, just to understand whether this growth was feasible, what we did is we chose a year when the largest bank in the country, SBI, and HDFC Bank had the same turnover. That was a shade above 1 lakh crores. And for SBI, this period was from 2002. So the blue line is showing the year when year one is when it was 1 lakh crore, and it had moved to around 16 lakh crores in FY17. And HDFC Bank hit that target of 1 lakh crore in the year 2010. And if you notice that both the lines have mimicked each other very significantly. So, considering the fact that SBI could traverse that path, there was no reason to think that HDFC Bank would not achieve it. And in fact, what we did is we did a comparative analysis of the various banking ratios, which we'll see in the next slide, over the same period. I know the data is very thin, but what I would like to point you that over this entire period, the performance of HDFC Bank has been far superior to that of uh, SBI. So, for example, the PAT growth of HDFC is expected to be above 15%, whereas that of SBI was negative. The ROA of HDFC Bank was in the was around 2.0, while that of SBI was less than 1. So all these kind of measures clearly show that HDFC Bank has got superior parameters in place. The trajectory of growth till date was mimicking that of SBI, and there was no reason that the company would not manage that kind of growth going forward, given the fact that it has got superior metrics at play. And the profitability of the bank would be far, far superior to that of SBI. And hence the growth multiple of 5, which as per our P band chart was showing to be on the higher side, is expected to sustain. In fact, we believe that the stock in FY20 should be around 2300. So that would be a 50% upside from where we had projected at 1300. And we are almost halfway there. Now, taking off on continuing with the price to book value ratio, I would like to draw your attention to IndusInd Bank and highlight to you how the re-rating of the PE happens. So we saw a re-rating of PE happen in solar industry, the first example. Now, if you notice here that we have written first cycle 2.4x, second cycle 2.9x, third cycle 3.9. So what this is essentially saying is that the IndusInd Bank up to March 2008 had a very pedestrian or ordinary and forgettable performance. However, the change in management with the professional management coming on board from the best of the industry, they had etched out 3 roadmaps, 3-year targets typically. And during the first cycle, the P of the stock got re-rated to an average of 2.4. In the second cycle, it was 2.9. And in the third cycle, the average P went up, price to book ratio went up to 3.9. In the lower chart, what we are showing you is that uh, is the red line is essentially the HDFC Bank uh, multiple, and the blue line is the IndusInd Bank performance vis-a-vis the HDFC Bank. So if you notice, there has been a significant catch up in the performance, and in fact, very briefly it has shot up beyond that of HDFC Bank also. This is given the fact that it's a relatively small bank with extremely high growth rates of close to 30%. And given that fact, so just like you use the PEG ratio, if you were to consider price to book divided by the growth, that would be kind of a similar measure to use. And on that basis, also the performance of industry in bank was far cheaper, uh, uh, relatively cheap despite its high valuations. Staying with the banking sector, and now we look at two stocks which are Yes Bank and IndusInd Bank. Okay, there was a stage in FY16 when the measure of IndusInd Bank was quoting at half the multiple of uh, IndusInd Bank. It was during this time when we had put out a buy ratio on buy call on Yes Bank. Now, despite the fact that the loan book was set to outpace that of IIB over the forecast period, and the loan book was more granular, had a higher retail exposure, and which ensured reduced business risk and volatility. And because of the granular nature and retail growth prospects, NIMs were expected to move up and catch up with them. There was also CASA expansion happening, which would lower the costs. Asset quality at that point in time was absolutely impeccable. It had superior operational efficiencies and had comparable return ratios. So, despite these facts, Yes Bank was quoting at a 50% discount to IndusInd. And this is the point when, at 600 rupees, the stock saw a very sharp re rating in FY17 to almost 1500 levels. So, this is how you can use relative valuation combined with qualitative aspects to determine which stock is to be bought. Having seen the three most popular methods of valuation, that is price to equity, price to book, and EV by EBITDA, we will now look at SOTP or sum of the parts method. Typically, this is used to value conglomerate businesses which have got a cluster or bundle of businesses rather than one unique business. So herein what we do is we value each business separately and then do the sum of the valuations. This is a basically of the compilation of the other valuation methods that we already discussed, wherein each of the business verticals for a conglomerate would be treated as an independent business and valued based on earnings and assets. So here we have done the SOTP valuation of Tata Motors. So here Tata Motors, it was very easy to do because Tata Motors has got a standalone business which is of the Indian operations. JLR is a subsidiary business of UK, and it has got three other subsidiaries, which is Tata Technologies, Tata Devu, and Tata Motor Finance Limited. And it has got 100% holding in all these subsidiaries. So we have used across these the first four verticals, we have used a P multiple for valuation, uh, and we have assigned the P multiple, and based on the EPS, we have projected the value per share. Mind you, for Tata Motors Finance, we have used a price to book value method. So where this book value was 6.2, we have assigned a multiple of 1.2 to arrive at this value. And this was done when the stock was 421. Our target was 616, which was achieved during that time. Having seen this, now let us brush through the other techniques. We will just touch upon them. We will not be going into the depth because the process and pattern are very similar. So you can use dividend yield valuation. So which is the dividend divided by the price per share. And if this is less than the bond yield available to you, then you're getting an equity based business at a valuation which is far cheaper than uh, the debt yield, which is far more lucrative than that. Then you should go for this kind of stock. However, you need to ascertain that there is growth happening. Typically, stocks quote at extremely high dividend yields when there is questionability on the application of cash flow of funds which are generated by the business. For companies which have got which are extremely high growth sunrise industries, we typically use the EV to sales method. Here, these companies are not expected to generate profits for a over the horizon profit horizon, and generally to value them, we use a EV to sales method, and sometimes which is this method is an expansion of the price to sales valuation method. The other method which I used is free cash flow yield method. This is an overall return evaluation ratio which standardizes the free cash flow per share a company expect to earn against its market price per share. So if you have got 3 4 businesses which are throwing up a lot of cash and you want to know which stock to buy, so for example, let us say you're comparing PVR with Inox, and PVR is at an extremely high valuation, Inox is also there, then you can use the method of free cash flow yield method to value stocks and buy the one with the most attractive yield. Other methods which I used are the price to operating cash flow as well as market cap to sales valuation method. One important measure that I would like to introduce here is the Altman Z score method. So to keep this short and sweet, what I would say is that the Z score, which is around below 1.8, typically indicates that a company is likely headed for or is under the weight of bankruptcy. And if it has a score above 3, the company's financials are very healthy and are less likely to experience bankruptcy. A score between 1.8 and 3 is a gray area and needs to be typically analyzed and scrutinized in greater detail before looking at these stocks. So the method simply for valuation stocks overall would be to check the Z score, then compare the valuation of the stock 1 year forward based on uh, multiples, then check along with peers, and then get into the fundamentals to ascertain the relative valuation of a particular share. This would be the short and sweet of the valuation process. That before we end, I would like to introduce to you also how you can use these valuation bands to look at the index. So this is the chart for the Nifty earnings, which is 1 year forward and 2 year forward. So if you notice that the blue line is showing 22.2x and on a 1 year forward basis, which is telling us that the market is very uh, very expensively valued, because if you notice historically on this ratio, whenever the valuations have surpassed the blue line, they've tended to react. But since we are at the end of FY18 or CY18, we need to look at CY17, we need to look at CY18 valuation, and you'll notice that it is trading at 16.6 multiple, which is the average of the period since 2006. And earlier I told you about the brown line being a stress level valuation. So if you notice in this chart that the P 1 year forward, the 9.6 multiple was the lowest that the stock went to, and the green value, which is in extremes, this happened. This is a once in a century kind of event, and typically the green line has tended to be a very good value buying level for the stocks. So by just eyeballing with these bands, you can also decide whether how a stock valuation is with respect to its historical valuations and buy into them. The same can be extended to price to book value. And if you notice on both ratios, uh, the stock is quoting below the averages, and hence there is no cause for concern in the market. Yes, corrections can happen, and hence I believe that the markets are not that expensively valued. If the growth momentum picks up, then there is substantial room to expand the price to book multiple. And in a full blown economy with all growth firing on all cylinders, this can very well expand to 3.3 from 2.7, which would be a 20 plus percent upside from current levels, purely based on valuations, not taking into play the earnings. So, ladies and gentlemen, this could be a year of growth, contrary to what market pundits are telling you. So, I end this presentation with that, and I welcome all your queries and doubts. Please contact me on WhatsApp. You can on 9730836363, or you can email me at bolinchka.win@gmail.com, or you can even send me queries on the YouTube channel of Market Studies, School of Market Studies. Thanking you. That's all.